In this section, we're going to discuss how prices move and who the players are behind it. When you understand how traders make prices move, then how you need to think to generate consistent results will start to become clear to you. Okay, where we're going now is that I think what I said when just before the break is that when you guys understand the nature of price movement and how any technical methodology that's based on a mathematical formula or a price pattern interacts with that movement, when you understand that relationship, how you need to think will become self-evident. Do you remember me saying that? Okay, this is the part that we're going into right now, okay? In other words, where you understand just exactly how prices move. Because what I found in doing these workshops over the years is that here I'm addressing a group of people who trade and who in many cases have traded for years. And if you ask somebody exactly how do prices get from one price to the next, they can't tell you. They don't know. They don't know how it happens. And maybe you guys I'm sure you guys aren't that group, but we'll go over it just as a refresher, okay? We'll do it as a kind of refresher. So, oh. No, actually, I haven't addressed a group yet that there were very few people, or if anybody, could tell you exactly how prices move from one price level to the next. So for an example, 10, 9, 7, 6, 11. Okay. If the last reported price that you see on your screen of something is 10, how does it get to 11?
They asked 12.
What?
They asked 12.
Who's they?
Market maker.
The market maker asked 12, okay? Well, no. Well, okay, it's at 10. How does it get to 11? How does the price actually move to 11?
More buyers.
Well, more buyers, but that's true. But then again, when you what's that? Demand, okay. But when you look at 10, what you have is you have offers at 11 and you have bids at 9, right? Everybody understands that? Okay, now, there's only two ways that anybody can make money in this business. There's only two possible ways, no matter what strategies you're employing, no matter how elaborate they are, no matter how simple they are. You have to be able to buy something at a low price and sell it back at a higher price, or sell something at a high price and buy it back at a lower price. Are we in agreement on that? And would you also agree that everyone that trades is trading to make money?
Yes.
In other words, I'm going to say that there isn't anybody who puts on a trade that does so knowingly and consciously thinking it's going to be a loser. In other words, where they go into the market and say, my purpose is to lose money. Okay, you guys with me on this? Now, if the only way that you can make money is to buy low and sell high, or sell high and buy low, and the last price, posted price is 10, which represents the value at that moment, then what's low? 9 is low. And what's high? 11. What's the only way that it can get to 11? Somebody thinks 11 is a good price, meaning that they have to buy high relative to the last price, right? So for an example, so basically what this also means is that all the offers have to be taken out at 10, do they not? Anybody who had an offer in at 10 that wanted to sell at 10 will get filled, and all those offers have to be taken out for the price to go to 11. Correct? And of course, and for the price to go to 12, all the offers that exist at 11 have to be taken out so that someone could actually bid the price up to 12. For prices to move, somebody literally has to bid the market up. Or for prices to go lower, it means that someone has to offer it lower. Now, if the only way that anyone can make money is to buy low and sell high and buy low, why in the world would anybody bid the market past the last posted price?
Because he thinks he got a winner.
Conviction, exactly. Conviction. In other words, what you have is a situation where on every trade that exists, there are two people on both sides of the trade. Even in stocks, there's even someone who's selling a stock, not like a commodity where in a futures contract or an options contract, there's two people on both sides of the trade. There's a buyer and there's a seller, and the next tick is going to make one of them a winner and one of them a loser, right off the bat. If you and I enter into a trade at 10, okay? We enter into a trade at 10. It means that you, in essence, if you're the seller, let's say you sold them at 10 and I bought them at 10. The next tick is going to make one of us a winner and one of us a loser. If the next tick is 9, the amount of money that flows into your account is coming directly out of mine. Are you guys with me on this? If the next tick is 11, the amount of money flowing into my account is coming directly out of your account. Okay? So basically what you have is you have two diametrically opposing beliefs entering into every single trade. Every trade that is made, there are diametrically opposing beliefs about what the future is going to be. So again, I'm going to say, what would cause anybody to buy high or sell low? Just conviction. In other words, what you have is a situation where if someone's willing to bid a market up to the next highest price, basically what that person is doing is that person is stepping out, saying that my conviction that the price is going to go to 12 or beyond is so great that I am willing to do the opposite of what I need to do to make money. Think about what I just said. I am willing to do the opposite of what I need to do to make money because my conviction is so strong that the next price will be 12 or 13. Otherwise, this person would wait. If this person thought the next price was going to be 9, then they'd buy lower. If they thought it was going to be 8, they'd buy low. They'd wait and buy lower. So what happens is that the person who's willing to bid a market up and take out these offers at 10, take out all the offers at 10 and bid it up to 11, has to have a stronger conviction in the future than the person who sold it to him at 11. Because this person is creating price movement, is actually creating movement, and the person on the other side of the trade is being passive because they're doing exactly what they think they need to do, and that's sell high relative to the last price. Are you guys with me on this? Okay, everybody understand it? Now, I want to ask you, is there anybody in this room who has purposefully bid up a market? There are some people who've actually bid a market up. In other words, the people who've actually taken the offers, all the offers out at the next highest price and bid it up. Do people like that exist? Yes. So in other words, we are aware of the fact that there are traders who both have the financial and the psychological resources to actually purposefully bid markets up or offer them lower. We're together on this, right? Okay. So basically what you have is that all price movement has to be a result of an imbalance in the degree of conviction between the traders who believe that prices are going up and those who believe that it's going down. That is the only way that prices move. It doesn't matter what the reasons are that people tell you about why they did what they did. Or it doesn't matter what the reasons that you hear on CNBC or whatever about where the market is and why it went the way that it went. Ultimately, it all boils down to an imbalance in conviction. That's the only way prices can move. Because the only way they can move is for someone to actually purposefully bid it up or offer it lower. And for them to do it, there has to be, like a sense of strength in terms of energy in their belief that the next tick is going to make them a winner. Okay, so we basically, does everybody understand? Everyone's with me on this. All price movement is a result of an imbalance in conviction between the buyers and the sellers. Every trade that's made, there's somebody on both sides of the trade that have diametrically opposing beliefs. You're always having, with every single trade, there's always a clash. There's always a clash in wills and a clash in belief in terms of what the next tick is going to be or what the future holds. We've got two people entering into, in a sense, an agreement by making a trade, but both of those people have diametrically opposing expectations of the future. And one of them is willing to say, hey, you know what? My expectation is so great, is so strong, that I am actually willing to do the opposite of what I need to do to make money and bid a market up. Now, there are traders who will do that. I call them dynamic traders. They are the people that have, like I said, both the financial and the psychological resources to actually bid markets up. What the typical, and what I'm going to call everyone else, passive technical traders, okay, they've got dynamic traders and passive technical traders. What the typical passive technical trader doesn't really, I'd say, really not aware of or think about is the fact that the only way that they will find themselves in a winning trade is by the actions of the people who are willing to bid a market up and offer it lower. That's the only way that it happens. In other words, when you and I get into a trade, and I am a passive technical trader, by the way. I'm not one of these dynamic guys. I don't bid markets up and offer them lower. Okay? That when you and I get into a trade at this price right here, let's say we bought at 7, we're buyers at 7. What are we really saying when we get into that trade? Bottom line, what are we saying? Based on the dynamics of what I just explained. We're saying that I think that someone is going to come into the market after me and buy at a worse price than what I did. That has such a strong conviction that this market is going to go up, that person is actually willing to buy at a worse price than me, to buy at 8, to buy at 9, to buy at 10. Because if there isn't anybody else that comes into the market to take out all the offers at 8, take out all the offers at 9, take out all the offers at 10, that market ain't going up. And I'm not going to be in a winning trade. You see, the implications are every single trade that we put on as passive technical traders, we are in fact obliged and dependent on other people who are willing to do something at a worse price than what we did it at. Or we won't be a winner. Are you guys following me on this? Is it starting to put the idea of trading into a different context? That in essence, what you're really trading is other people's perception of what is high and what is low? That any technical indicator, any price pattern that you might trade, any trade that you put on, you are basically trading other people's perceptions of what is high and what is low. Now, when you think about how well you might know other people's perceptions, you think about it in that context, it might not make a lot of sense to get so fixated on staying in a trade that isn't working. It might be a little easier to put in a stop. And to say, hey, you know what? If people aren't coming in to buy at a higher price than me, I'm going to give them this much room from here to here, and if they don't come in, I'm out of this trade. I'll just go to the next one. Because that's basically what you're doing as a trader. You are completely dependent on other traders to make you a winner. Now, who are these dynamic traders? Who are the people that are going to do this and why? What? Hedge funds, okay? Money managers. In the commodities arena, do you guys really know how the futures markets even started in the first place? Or why they even exist? I know people probably exist because they're on the screen and it's part of the platform, but there's actually a legitimate economic purpose for these things. And when you get to the when you understand the underlying reason for these markets, you'll understand why they trade the way that they do and why prices move the way that they do. For an example, what happened in the past is that, for an example, if you had a farmer who planted their corn in the spring and harvested the corn in the fall, what they were dependent on, of course, was a lot of different factors that they had no control of. One of them being the weather, and one of them being how much other corn was planted out throughout the country, and how much of that corn would end up in the market in the fall in relationship to what the demand was. So if there was a lot of corn and let's say the demand remained relatively constant, the price of the corn would go down and the farmer would lose money. If there wasn't a lot of corn and demand would remain constant, the price would go up. If there wasn't a lot of corn and for some reason demand was really high, and the price would go up even further. So what you had is a situation where there was a great deal of economic risk in being a farmer or being anybody that manufactured anything or dug stuff out of the ground like gold or silver or manufactured electric motors that needed copper or whatever goes into all the products that we use. So what evolved was a situation where the farmer and the manufacturer, let's say of bread that needed the flour, they would enter into what was called a forward agreement, meaning that they both wanted the economic risk taken out of their business. They both wanted to be able to make a profit. They both wanted, to be able to have some sense of certainty as to what prices might be at some point in the future. So for an example, if I'm a farmer and it costs me $4 a bushel to plant my corn and bring it to harvest or bring it to market, then for me to make some money, I want at least $5 a bushel, right? And if I'm the guy on the other end of that trade or the other end of that transaction that wants to buy that corn in the fall or wheat or whatever, and I want to know exactly how much I'm going to have to pay for it. So what ends up happening is that if, let's say, it's April or it's March, and the price of corn is $4 a bushel, you enter into a forward agreement with the end user, and they say, hey, you know what? I will deliver $1 million or 1 million bushels of corn or 100,000 bushels of corn at say $4.50 a bushel or whatever price they agree on, or $5 a bushel, regardless of what the price of corn is in the fall. So if the price of corn in the fall happens to be $3 a bushel because there's so much demand, or because there's so much corn and very little demand, then the farmer actually still got his price at, let's say, at $5 a bushel, but the manufacturer ended up having to pay $2 a bushel more than what he would have if he had waited and just bought his corn on the open market in the fall. So in that sense, he seemed to lose on that transaction. But then the next year, what ends up happening is that there's very little corn, or there's more demand than what there is corn, and the price of corn ends up being $7 a bushel. And the farmer would have made the $7 had he not entered into a forward agreement. But what ends up happening is he still made his $1 a bushel profit, and the end user ended up saving himself $2 a bushel. So over the years, all this evens out. Well, so then what happened then is that exchanges, in other words, instead of these people individually entering into these transactions, exchanges were developed. So in other words, they had a central place to come to and make these transactions, like the Chicago Board of Trade and Chicago Mercantile Exchange. Well, what ended up happening is that with the advent of exchanges, what you had is a situation where there were people that were willing to take the other sides of these trades that had nothing to do with the actual process of making bread or growing wheat or corn. They were called speculators. And then that's when futures contracts, came into being. So what would happen is that if I'm a farmer, instead of me having to make the transaction directly with with someone who manufactures bread, I could go to the Chicago Board of Trade and sell my corn or wheat with a futures contract. And so if I'm selling it at $4 a bushel, and so that means I'm long corn. This is where the long and the short comes from. I am long cash. I'm long corn, and because I've got a crop in the ground. And so if I sell it at $4 a bushel on a futures contract, I take the equivalent number of futures contracts. And so if the price of corn goes down, or let's say the price of corn goes up, I've already locked in, well, I'm going to sell it at $5, but I've locked in my $1 bushel profit. So if the price of corn goes up, what I've done is I'm short futures. I'm short the actual futures contract. I'm long the corn. So I'm going to lose money on my futures contract, because as the price goes up, I'm losing money, but I'm making money on my cash. So I'm making the equivalent amount of money on my cash as what I'm losing on my futures. So in any case, it doesn't matter what the market does. The market can go up, the market can go down. I've locked in my $1 profit bushel, $1 per bushel profit. And the person on the other side of that trade, the speculator, if, of course, the market goes up, then the speculator is the one that makes that $2 a bushel profit if it goes up to $7 a bushel. Okay? You guys with me on all this? If the price, of course, if the price of it goes down, then I'm losing money. I'm losing money on my cash crop, but I'm making money on my futures contract. And the speculator on the other side of the contract is losing money because the market's going down. In other words, the speculator is just one-sided. The farmer is two-sided. He is hedged. That's what's called a hedge. Now, what's interesting about all this is that as these markets evolved, you will find that the farmers don't trade against each other, or the grain elevators, or the people the commercials who actually are involved with the production and manufacture of anything. They don't take the other side of each other's trades. What they do is they want speculators to take the other sides of their trades. In other words, if I'm a commercial grain elevator, I'm not going to be another commercial grain elevator is not going to be taking the other side of my trade because we're both going to be doing the same thing. Okay, if I'm a farmer and I'm going to sell my wheat or sell my corn, the farmer down the street who also trades isn't going to be taking the other side of my trades. What commercials and hedgers and fund managers and all the people who are really, let's say, professionals, they have become very, very sophisticated at finding ways of drawing the general public into taking the other sides of their trades. Meaning, and the point that I'm making here, is that they will purposefully do things that will draw the typical general public, let's say the general public, into the other side of their trades, when in fact what they want to do is the exact opposite. For an example, let's if I'm a hedge fund manager and I'm long stocks, or it doesn't really matter what it is. I could be long bonds, I could be long gold, I could be whatever it is, and I want to liquidate my position. Now I've got a huge position, meaning I've got a cash position, and I want to sell it. If I go into the market right now and sell my entire position, what do you think is going to happen to the price? Chances are it's going to go down. I am actually going to, because of the volume of my trades, I am actually going to drive the price down, making my average cost lower and lower. I don't want to do that. I don't want to, so for an example, if I come into the market and I say, hey, you know what, I've got 10 million shares of this and that to sell, what's going to end up happening is that those 10 million shares are going to end up taking out all the bids, all the prices down, take out all the bids until you find a spot where it can't take out, where the size of the trade cannot take out any more bids and the price stabilizes. Okay? So I'm thinking to myself, now, what you get is you got these, what I'm going to call like these hot shot kind of hardcore traders, where, you know, to make a name for themselves, because they're in a big trading room and they compete amongst one another and their bonuses depend on how well they do. What if they did something like this? I'm looking at a price chart. Let's just say they could be daily bars or whatever. Okay, and this is like a swing high, swing low, okay? Now, interestingly enough, as we're talking about this, I want to make a point about what does this price represent right here, and what does this price represent right here? What? Yeah, we're going to call it resistance, but more from a practical matter, what does it represent? What's that?
Nobody believes it's going to go higher.
Ah, yeah. In other words, there wasn't. No, you're right. He said there's nobody believes it's going to go higher. It represents there wasn't one person in the whole world, that was willing to bid the price one tick higher. Not one. Up to this point, there could be any number of people who were willing to bid it higher. But it got to a certain price level, and there wasn't one person left in the whole world that would bid it higher. This, by the way, is one of the reasons why technical analysis works, is because the market has a memory. This is why technical analysis works. The market has a memory. Because when the market came back down, you formed a swing low, came back up to this high, there were people who made money by selling this high. There's a good chance those same traders are going to come back into the market and do it again. As well as there are people who lost money by buying that high. Because for every trade that was made up to this last price, there was a buyer and a seller. There was a trader on the other end of the trade that bought that high. Now, when the market comes back again to the same price level, chances are there will be an imbalance between the buyers and the sellers. Just by the mere fact that the people who made money are going to be willing to trade it again and come into the market maybe with a lot of ferocity. And the traders who lost money by buying that high are probably not going to be willing to do it again. And so what you have is even more of an imbalance that existed the last time. Are you guys with me on this?
I'm waiting for it to break through.
Okay, well, that's fine. You can do that. However,
Are you going to explain that part, what they're thinking?
no, I'm not going to really the most I'm going to do is get into what we're just doing right now, because this is not, this is not a course in technical analysis. I mean, and it doesn't really matter anyway, because you guys are trading off of mathematical formulas and not doing subjective trading. So, and this would fall into the category of subjective trading. Subjective trading also is the equivalent to who watches Texas Hold'em tournaments like on TV? Anybody? Come on, give me more of a show of. So you've got categories of development where initially people, when they play Texas Hold'em, you play your cards, and then you get good enough at playing your cards. What you start doing is playing the people, and you get so good that you don't even have to play your cards. You don't have to look at your cards. You just play the person. That's the equivalent to subjective trading. Okay, what you're doing is you're using a process of deductive reasoning to determine who's thinking what and what they're likely to do. Okay. And the only reason I'm giving you all this information and making this point is so that you understand with no uncertain terms that there is a whole category of traders out there, people out there, traders, people who have both the financial and the psychological resources to bid markets up and offer them lower. And what's the point that I'm making? The point that I'm making is that any particular technical methodology that you use to determine a pattern is present that gives you a higher probability of one thing happening over another, until you can get into the minds of the people who actually move prices, you will never know for sure what's going to happen next. The only people that know for sure are the people who are willing to do it. And that's what you got to burn that in your brain. You will never know for sure what's going to happen next, unless you can read the minds of the people who are going to do it. And there are people who will do it. And they do it all the time. That's the only way you end up in a winning trade. Most of the time when you end up in a winning trade is because of what these other dynamic traders are doing. So to convince you that there are people who are willing to do this, if I'm a hedge fund manager and I've got to unload a huge position and the market happens to be sitting right here in relative to this chart pattern, how might I maximize my profits? What might I do? Now remember, I've got to sell. I'm going to be a seller. But what might I do to make sure that I get the best price? What?
Drive it up and sell.
Yeah, drive it up. In other words, I will do the opposite of what I want to do to get a better price. And I will drive it up. But how much risk am I taking by doing that?
Probably not a lot. If you sell it just a little, drive it up, and sell a bunch coming back down.
Well, yeah, I mean, if I drive the price up by taking out these offers and then bidding up, taking out an offer, in other words, I can look with depending on the kind of software I have, I can find out what depth, the depth of the market, meaning that and I'm not saying these are hard offers because people pull their offers all the time, but I can look at this high and I say, you know what? How much money might it take for me to drive the market from here to just past these highs right here? How many offers do I have to take out to do it? Just tally it up and see if you want to spend the money. Because in essence, how much risk are you actually taking? See, by driving it up, what you're doing is you're increasing the asset value of your portfolio. So in that sense, you're not taking any risk. You're actually making money. If I continue to drive the price up, I am actually making the trades that I made down here winners. Every tick that I drive the price up, I'm making myself a winner on the trades that I made at lower prices. To actually drive a price up because you are making yourself a winner at the prices that, what you bought at lower prices. If, for an example, by me driving this price up, it draws other people into the market, that will help, will it not? Because it creates more of an imbalance. Now, that's the real thing. What I want to do is I want to get more buyers into the market. And the reason why I want to get more buyers into the market is so somebody is there to take the other side of my sell orders. Because that's ultimately what I'm doing here. What I'm doing is I want to sell. So what I'm doing is creating a bigger pool of orders to come into the market till I can sell into so that my sell orders don't drive the price down. And so I will purposefully do the opposite of what I want to do, ultimately, with respect to my position. Now, the reason why I'm selling has nothing to do with this chart pattern. Absolutely nothing to do with the chart pattern itself. I'm just using the chart pattern as a means to maximize my profits. Now, what if I managed to drive it up to resistance? Chances are there's going to be a lot of sell orders coming in that I'm going to have to compete with. That's a risk that I'm taking here. But what if I can drive it a little past that resistance? What I'm going to have is a situation where all the people, the other traders who sold at this level right here, that came into the market because it was approaching this previous high, they're going to put their stops a little bit above the market. Now, what kind of stops are they going to be? They're going to be buy stops. If they sold to get out at a loss, they have to be buyers. If I can drive the market to those buy stops, I have given myself an instant pool of orders to take the other side of my trades and get me out at maximum profits. This is typically what you see in a chart pattern as a false breakout. Because what will end up happening is that as soon as my order hits the market, it's so large, and then because there really weren't that many other traders that were willing to continue to bid the market up, what it'll do is it'll take out all the bids and then drive the price right down. That's called a false breakout. It's being done at different time frames all of the time.
To do this, you have to have a large enough position so that when you drive up your cost basis, it's incrementally small compared to where you really are today.
Yeah.
And then, as you said, you get up to either you do it below that resistance, hope you break above, and then you just dump your shares.
Right. Right. Thank you.